This video is about infinite banking. Now, I know the topic of infinite banking can seem a little bit complex, but I'll do my best to explain it in easy terms. So, what exactly is infinite banking? It is a financial strategy where you use a cash value life insurance policy as a savings tool to take control of your banking needs. Now, how your policy is set up is key. It's all about maximizing cash growth. While some policies focus on death benefit, infinite banking prioritizes cash growth. Setting it up right is crucial because it ensures your cash is available to borrow when you need it most. So work with someone who will set it up in your best interest. Think about how we typically manage our money. We get paid, it goes into our bank accounts, and then we use the money to pay bills and make purchases. With infinite banking, you still get paid in your bank accounts, but you will put a portion of your money into your policy as premium. And when it's time to make a purchase, like a car or furniture, you will take a loan against your cash value of your policy. Now, why go through all this trouble when you could just pay from your bank account? That's a good question. And in order to answer this question, let's understand the different ways we usually make purchases on a daily basis. First, there's traditional financing, which means taking out a loan to buy something like a car or furniture and then paying it off over time. So you go into debt, pay it off, and get back to zero. You are constantly in a cycle of borrowing, paying, and getting back to zero. Then there is also savings method, which is the opposite of traditional financing. You save up until you can buy something outright. It's straightforward, but it means your savings will drop to zero each time you make a big purchase. The third method is sort of a hybrid between these two methods. In fact, it is what infinite banking uses. So you start by saving money within your policy. And then when you are ready to buy, you take a loan against your cash value. The insurance company gives you the loan, which means you will pay interest to them, not yourself. Now, some people say you pay the interest to yourself, but that is not how it works. But here is the benefit. Your full cash value keeps growing as if you never borrowed. So, for example, if you have $50,000 in cash value and you borrow $30,000 to buy a car, the full $50,000 grows. This is what we call uninterrupted compounding. It's very similar to how real estate works. For example, let's say you buy a property which costs about $200,000 with a 20% down payment. Well, when the property appreciates by 5%, you get the full growth and not just 20% of it, but you are obligated to pay the interest on the loan to the bank. So real estate investors really love infinite banking. When you repay the loan, the cash continues to grow over time. This method allows your wealth to compound faster because you are never actually depleting your money back to zero. It keeps working for you. To make this clearer, let's look at some numbers. Say you borrow $30,000 at 5% interest rate over 5 years. You would pay back a total of $33,968, which will include the interest of $3,968. At the same time, 30,000 is growing at 4% within your policy. I am using 4% in this example because a properly designed whole life insurance policy is going to return between 3.5 to about 5%. At the end of the 5 years, you would end up with about $6,499 in interest growth. So the money in your policy would have grown faster than the interest you would have paid on the loan, even if the interest is just 4%. This happens because the amount you owe on the loan keeps getting smaller. So after a while, paying 5% interest on a smaller loan balance costs less than earning 4% on a growing cash value in your policy. Now, infinite banking isn't without its challenges. It requires discipline. Although you are not required to pay back the loan, I will highly encourage you to do so. Otherwise, the interest will compound and it can impact the policy's performance. Treat your bank with the same respect you give to other banks. Plus, because it uses a life insurance product, part of the premium payment is used to provide the death benefit, which means 100% of your money will not be available upfront. But with the right policy design and understanding of the product, you can maximize your benefits over time. It's all about finding someone who will set it up in your best interest and to meet your specific needs. If you found this video helpful, please like it and subscribe to my channel. In the next video, we will dive into how to set up a policy for maximum performance. Don't miss it, so subscribe, and I'll see you next time. Thanks for watching. I am Gilbert. Take care. Bye.